Welcome, everybody, to this week's episode of the Self-Directed IRA podcast with yours truly, Mark Kohler, and the amazing Matt Sorensen at my side. Depending on your view on YouTube, he could be on my right side or left side. I don't know. So just there's a guy next to me. That's Matt.
I'm the guy next to him. I always want to be by your side, Mark. Wherever I am, I'm by your side. Yeah.
It reminds me of the movie Night and Day, when Cameron Diaz looks at Tom. You're the guy. I'm the guy. I'm the guy. You're the guy. I'm the guy. That's a classic. Tom Cruise. I mean, everything he touches turns to gold. You know, that guy.
Apparently, except just like relationships and personal life and religion. No, just kidding. We won't go there. We won't go there. Movies. Every movie he touches seems to be great.
Yeah, he does. So,
love you,
open
Tom.
forum.
Love you, Tom. Today, open forum. This is the Directed IRA podcast, and this open forum where it's your time. We got tons of questions, and our website is back up with all the question and answer you can throw on at directedira.com/podcast. Throw in your questions. Mark and I are going to give answers today. Some will be good, some will be bad.
What? You know, you've got to manifest. Have you heard of that word? You got to project positive attitude.
You know, I'm not about all the manifest BS. You know, I'm about setting expectations. So when you guys get through this, you're like, man, that was really good. I didn't hear one bad question. That's what I was setting it up for.
See, Matt's adopted my daughter Sydney's approach to life. She one day said to me, Dad, you know what the secret to life is? I'm like, pray tell, please. I've been waiting for you to turn 19 so you could tell me the secret to life.
What you figured out. And
yeah, I've been waiting my whole life for this moment for my teenage daughter to tell me the secret to life. And she says, low expectations.
Yeah.
And so Matt here is trying to help all of you have a great podcast by just setting low expectations so you'll be wowed. So,
well, let me say this too. Sometimes we have amazing answers. Sometimes you don't like them. I've got some questions in here of people I think are hoping are going to say, we're going to be like, yeah, you can do that. And actually the answer is, yeah, you can't do that. So there's, just trying to prep you for that.
It's still a good answer. It's just still what they wanted.
Yeah. Still an accurate, correct answer. So,
okay. All right. So Matt's going to moderate today. We are going to rapid fire. I think we should set the goal today to not go down too many rabbit holes. Let's answer as many questions as we can. If you answered it distinctly, I will not add any commentary. If I answered it distinctly, I know you'll add commentary, but whatever. Okay. Just trying to set ground rules. Okay.
What Mark was saying there is, Matt, can you get to the point fast on all these answers? That's the subtext.
I didn't. Passive aggressive comments. Okay.
All right. I'm going to read these. I'm going to try and we got some great ones though. Love these questions. All right. This was from YouTube, actually, from prior episode. Menke, I don't know. Sorry if I'm getting this wrong. Says, is it allowable to have both self-directed 401k plan and separately a solo 401k brokerage account for trading, for example, at Fidelity? Can you have these both simultaneously? All right. Let me give you a straight, clear answer. Absolutely. You can have a self-directed account, which could be your solo 401k. It's the same solo 401k with the checking account, bank account. It could be custodial at directed. And that could be invested in alternative stuff, in an LLC, in real estate, in crypto, whatever you're into for the self-directed part. That same solo 401k plan can also create a brokerage account at Fidelity or Schwab. And most of those big broker dealers have those accounts. It's called an investment only account. So when you already have a solo K, you don't go to Fidelity to set up another solo K brokerage account. Because what they're going to do is they're going to do a whole new plan document that's another solo K, and then attach it to a brokerage account. What you do is you say, I already have a solo K, and these are called investment only accounts. And then basically what they say is, this is designed for someone who already has a plan document. You already have your plan adopted. You just need the brokerage account added onto it. So that's what you're gonna do there.
Okay. All right. That's to the point. Did I say I wasn't going to add any commentary?
I don't know. I think you did say that.
I will say this for everybody listening. I think her question is a good one to jump off on and say, people, you can have multiple 401ks. You can have multiple IRAs. You can have an IRA, a Roth, and a 401k. You can have an HSA, a 401k, an IRA, and a Roth. The issue is the amount of contribution you can make in a year. So
Yeah.
that the good news here is you can get flexible with different businesses and accounts, but you can, an example, only put $6,000 in. That might be 6 IRAs, 1,000 each, but you could. So anyway, there's the takeaway. I think good stuff. Okay. So,
all right. You ready for the next one? I'll throw this one to you.
Okay.
All right. Irma's question was, let's say the C Corp is established for a multi-member IRA LLC. Then the first 21% corporate tax will be applied on any company profits, but the second double tax on the dividend withdrawal also applies even if all the members of the multi-member IRA LLC are Roth?
Okay. The answer would be no.
Which is great.
Which is good news. Okay. So everybody, what's the caller's first name? Irma. Okay. Uma Thurman or Irma?
Irma
Okay.
Bogan.
Okay. Irma. I was thinking of
probably just as amazing as Uma Thurman, I'm sure.
I was thinking of Kill Bill, you know?
Yeah.
So, okay. All right. Everybody, here's what's going on. Sometimes your Roth IRA, because she's talking about Roth IRAs in this example, might be doing an operation that has a small business aspect. So let's say your Roth IRA is not going to buy a rental, it's going to buy into a little restaurant. So you and your 4 family members, the Gambino family, open an Italian restaurant in the south side of New York, and you're going to have your Roth IRAs own this restaurant.
Mm-hmm.
Well,
a highly profitable restaurant.
Highly profitable.
Very profitable.
Yes, there's a table always available for you. So this little Italian restaurant is an operational business. So in order not to pay UBIT tax, to make the playing field fair for other restaurant owners, the Roth would set up a blocker C corporation. So it's going to own this restaurant in the form of a C corp, and it's going to pay a 21% flat tax rate. Well, when the dividend comes out, it's a dividend. It's tax-free to the Roth. And when you pull the money out of your Roth, it's tax-free to you. So there's only one layer of tax. It's at the C corp level. A side example would be, let's say your Roth IRA buys Microsoft stock. Well, Microsoft's a C corp. It's going to pay corporate tax. And if it issues you a dividend, that goes into your Roth tax-free, and you pull it out of your Roth tax-free. So there is not a double layer unless an owner of a C corp is an individual.
Yeah.
Then the individual has to pay tax on that dividend. And that's Irma, where you may be getting tripped up. But if everybody's Roths, there's no double tax. If one of the 5 partners, you know, could be maybe a individual, and that I was going to go with some names out of The Godfather, but we're going to go down a rabbit hole, so I'll leave it alone. But anyway,
what happens is great and fast, concise answers.
I know. So if there was an individual, they'd pay double tax. There you go. Done. I'm out.
All right, done.
Tapped out.
Okay. Ding. Okay.
I'm out.
All right, love it. Okay, great question, Irma. Little complicated. So if that was over your guys' head, yeah, this is only for people doing some of those tricky things where you need that blocker corp. All right, Roberto asked, may I get clarity on rollovers? I currently have a 401k. I'm 32 years old. Am I allowed to roll it over to a self-directed Roth IRA? Thanks for all the advice. Okay, so Roberto, if you have a 401k and you're only 32, you're only allowed to roll that over if you no longer work at that employer. See, you're not retirement plan age yet at 59 and a half, where at that age, you can roll over whether you work there or not. When you're below 59 and a half, your 401k is usually stuck with your current employer. You can't roll it out.
Yeah.
Now, if you've left that employer, and this is a former employer 401k, you're able to roll it over to a self-directed account. Now, if it's a Roth 401k, then you can roll it to a self-directed Roth IRA. If it's a traditional account, you could roll over a self-directed traditional account, and you could later convert it to Roth if you wanted Roth at the end of the day. But that's the rules on how the rollovers work, Roberto.
I like it. And some of you that now have a small business but you've got this old 401k from a day job years ago laying around, you could open a solo 401k in your new small business and roll that 401k directly into the small business 401k, the solo, do a conversion to a Roth inside of that. You never go directly from a traditional to a Roth rollover. You have to roll over to a traditional, then convert to Roth. But the caller there, in effect, If you're not working at that job, you can do what you're thinking about doing. But if you're still employed, you're going to be stuck in their plan until you get fired or quit or die. So.
All right. Okay. George has a question here. This is from the website, directedira.com/podcast. He asked, a husband and wife partnership has adopted a solo K. It will receive management fees for providing management services to other real estate holding companies. The husband and wife have. Can the partners receive guaranteed income payments and use that amount as contributions into the solo K, or are they required to run it through as payroll and split out W-2s for each spouse? Trying to keep things simple on the 1065 and avoid the expense of running payroll. Happy.
Okay.
Team
Ooh, boy, do I have an answer for George here. George, I'm going to give you this solution, and believe it or not, it's simple. Just bear with me. You're doing it completely wrong. So I don't want to say completely. Okay, I'm going to give you two options. I'm going to give you what I think is option one is the simplest thing to do.
Yeah.
Make a freaking S election, do regular W-2 payroll, and zero it out as an 1120S. You're trying to get around from doing W-2s. I know what you're trying to do. And I'm going to give you option two, but the word guaranteed payment does not exist in this situation, because trust me. So when you were, and if you're trying to do your tax return yourself, you're in for a rude awakening. You're going to jack this up. So when you work with your CPA to do this tax return for this year, you want to, if I had a piece of paper, I'd draw a line down the middle. You can leave it as a 1065, or you can make the yes election. I would probably make the yes election, put the management fee in there, zero it out with the W-2s up to the amount you want to defer into your 401k, and then bring over a management fee for the company match portion, or even more if you want to learn about the mega backdoor Roth 401k type strategy. But the point is, make the S election, get away from the 1065, and just buck up and knock out a couple W-2s. I think that's going to be a lot easier for you, frankly. Yeah. Now, if you want to stay at 1065, you cannot issue W-2s in a 1065. Also, guaranteed payments mean that you're now creating a Schedule C. So you're taking a payment out of the 1065 and creating another tax return, which you don't want to do. That's why I was saying it was wrong to do that. So stay away from guaranteed payment.
But I would just jump. Go ahead.
But I'll just say, but you could take the 1065 and just show net profit subject to SE tax. So you both get a K1, and you could fund the solo 401k from that. Believe it or not, it's a little more clunky, because you're not, 401ks make a lot of sense with a W-2. With a K1 subject to SE tax, your accountant's got to be a little more savvy on how to do that, but you can do it. Matt, would you concur?
Yeah. And one other thing I would just say is, don't do the partnership for this management company. Just do a sole prop or the S corp that Mark's saying, and where you get the W-2s. Why don't you just do a Schedule C sole prop, and you can do still your Roth employee contribution. The match is a little different in a Schedule C, where you do 20% instead of 25. But I would probably look at just doing a sole prop.
Well, hold it. If you did, I'm embarrassed here. Some CPA is going to email me and say I'm crazy. But if you do a Schedule C, that's a sole proprietor. So I can only, that's only going to create a deferral for one of them. I don't think
Correct.
I can defer for both.
I see what you're saying. You want to they're trying to double up.
Yeah, they're trying to.
But let me say for everyone else, if you're just trying to get for yourself, but if you're trying to double up for a spouse, I think I would agree with what you're saying. You're going to have to just do an S corp or do an S.
Yeah.
So you can get two W-2s.
Yeah. Or you're going to have two K1s, no guaranteed payment. And the K1 is going to be, I think, box number 1, subject to self-employment tax, coded, blah, blah, blah. So work with your CPA. I would lean towards just making an S election, since you're trying to combine or contribute to both husband and wife's W-2s. Now, by the way, what he's trying to do is what we call the side door 401k, meaning they've got rental properties, but no way to contribute to a 401k without the management company. People, you would never set up a management company to manage your rentals. Don't get sucked into that rabbit hole with crazy advisors. Just the only reason we would do it is to do what they're trying to accomplish here, and that's contribute to a 401k.
Yeah. All right. Okay. Graham asks, this is from the podcast site. Hey, Matt and Mark, love the show. I recently opened up a self-directed education saving account for my son through directed IRA. And my plan is to also roll over my Roth IRA to directed and then form a multi-member LLC with these two accounts.
Was the first one an HSA? Is that what you said?
ESA.
Oh, okay. Coverdale.
Yeah,
okay.
Coverdale.
My new article that just went live yesterday, I used the word Coverdale through the whole article instead of ESA, just so you know, Matt. Okay.
Okay. Those are one and the same, just so everybody knows.
Yes, they are. Yes.
He says, my plan is to invest in silver or gold, but I also want to mine crypto under a blocker corp and use the LLC to be the holding company for both crypto and precious metals. The same multi-member LLC do both of these plans. Thanks, guys. Keep the movie references coming.
Okay, we got to get a good movie reference in here. So he's trying to do the Coverdale, which means he's trying to send his child to school to become a doctor, which most people would do in 7 years, but apparently Tommy Boy did not. Basically his head's full of bong resin and malted hops.
Lots of people go to school for 7 years. Yeah, they're called doctors. Shut up, Richard.
Shut up, Richard. Your head's full of candy. What was there a niner in there? Okay. Anyway. Okay. So we got a kid trying to go to college. Little Tommy Boy is going to college.
Yeah. Little Tommy Boy but dad, Tom Callahan, big Tom, he's got his Roth IRA. So we got the Coverdale ESA Roth IRA doing an LLC, a multi-member IRA LLC. They want to buy gold and silver. Great. You can do that right out of this IRA LLC, Graham.
Easy schmeezy.
Easy smeezy. But once you say, I want to mine crypto, I'm like, all right, are you going to make more than 10 grand a year or more on this crypto? Because if you are mining crypto under this entity, we're going to want to do a separate blocker corp. Now we've got episodes on this. So you're going to have a holding company that's the multi-member IRA LLC, and then a 100% owned IRA LLC taxed as a C corp. That's the blocker that'll do the crypto mining. The precious metals are down here where you're not paying corporate tax. It's just a holding company. There's no UBIT or anything you got to worry about there. The mining's up here though, in that mining blocker corp. So if you can do both of these things, but the mining piece is adding this blocker corp that you're going to need. Now, if you're like, guys, I'm going to make a couple $1,000 a year mining crypto, I'm not doing a lot of it. Cool. Then just do it in this entity. You may have a little bit of UBIT. You might be under the exemptions and have expenses where it doesn't matter. So
yeah, my general advice would be to if a Coverdale by nature, if you're just starting to form this, is going to have just a few $1,000s in it. And to try to set up a mining rig that's worth the time and effort and money, I think having a Coverdale in the mix is going to be a very small owner of the multi-member LLC, hence blocker. But if you've got enough money, I think you need at least 20 grand or more to really get a mining rig off to the races where it makes sense. So see what your capital is you're dealing with. But if you want me to just put it in a box and write guaranteed on it, I can do that. But some burglars are going to come in at night.
Yeah,
it's not going to be good. So
yeah, love it. All right. Okay. Cheryl asks, this is Cheryl from Tennessee, says, can you make a contribution to your solo 401k from multiple streams of income as long as you're paying self-employment tax from your income and are in compliance with the other rules for solo 401ks?
What's her name? Cheryl. The answer is yes, Cheryl, but you've got one hoop to jump through. And this, many of you might find this fascinating. I can speak for Matt too. He and I each have one S corp in our lives. That's it. That's all I want. You guys are like, well, you have a law firm and you're doing all these 401ks. You probably have like 5 S corps. Nope. I only want one. Now, all my multiple streams of income that are operational are going to flow into that S corp, whether they're K1s, 1099s, Stripe, Square, whatever. So the point is, have all of those streams of income go into one entity that sponsors the 401k you're talking about.
Yeah.
If you have multiple streams of income going into multiple Schedule Cs and trying to put it all in one 401k, I don't think you're going to be able to pull that off. You want to have it all go into one entity, one 401k, but you can have multiple streams of income to pool it. Would you agree?
Yeah. Yep. Yeah. And I think one little instance that sometimes occurs is, let's say you have your S corp, that's your main entity, and that's the entity you adopt the solo K under, but you also have some sole proprietorship for whatever reason that you have laying around. And that's possible where you can name that as like an affiliated employer or under the plan. So you can have multiple entities. Now, again, from a tax and legal standpoint, we don't structure it that way. We would just say, get rid of that sole prop and just run that income into the S corp. But actually what happens more is the opposite, where we've had clients that set up a solo K in their S corp. Or sorry, they set up a solo K in their sole proprietorship and they later set up an S corp. And now we got to make both of those employers. But eventually you're going to start running income through the S corp. So
yeah,
hope that helps, Cheryl.
Okay. All right, man, we're burning through today. We're rocking. All right, this is good.
Teresa Hancock, this is from YouTube, asked, if I did the LLC and owned a property and funded maintenance out of my personal checking account, could I then do the work myself? Could I paint myself, take out the trash? She's got a second question. Let's just hit that first question. So she's got the IRA LLC, it owns a property. Can she put money in personally and then pay herself back for doing the work herself?
This is a rental property.
Yes, owned by your IRA LLC.
Sorry, was that sounded really rude the way I snookered there. Was snooker? What's a snooker?
Teresa,
the answer is
the answer coming is not good.
The answer is no and no. You can't do it even if you didn't have an IRA owning it, and you certainly can't do it if your IRA owns the LLC. So I am so sorry. Yeah, your IRA cannot own an entity and pay you for services. Maybe if it's a minority owner and you have arm's length third-party people that own the majority of the company and they're willing to pay you to do services and they're the check and balance to make sure it's legit, you could pull that off. But you're not going to pay yourself for the work. I wish you could, but Iras doesn't buy.
So like, for example, Teresa, let's say that me, you, and Mark each owned 1/3 of an LLC, and it was your IRA, my IRA, and Mark's IRA, each owned 1/3 of an LLC. And you're like, hey guys, I want to do the rehab on this. I want to do the painting on it. I'm great at painting. We're like, okay, cool. That would be okay. You could personally do the work. The LLC could pay you because your IRA owns less than 50%. But in this instance where your IRA owns the LLC 100%, or even if it was a multi-member IRA LLC of your personal funds and you can't get paid for doing work. So it's still going to be a prohibited transaction, nor can you even do the work and not get paid. Okay. You can't do physical work on a property, even if you're not getting paid. So either way, it becomes prohibited.
Yeah. Sorry about that. Okay. Next question.
Okay. Let's jump back to, all right. Here's a good question. This is from Anthony. Man, we got a lot of Tennessee questions in here.
Okay.
All right. Anthony from Tennessee says, I have a solo 401k and traditional dollars from a 401k through a job. When I move it and then convert it to Roth solo K, can I use my carry forward depreciation bucket for my rental properties to pay the tax on the conversion?
Okay. Let me restate.
Basically, can I convert my traditional 401k dollars to Roth and use my depreciation for my rental properties to offset the taxable income?
Okay.
Right?
Let me rephrase the question for Matt to answer so everybody gets their head around this. This is a great question, Anthony. So everybody out there, assume you have a rental property that you own personally. Now we got to make that assumption for Anthony here.
Yeah.
He really doesn't clarify if the 401ks own the rentals. So we're going to that would not work. So let's just assume Anthony's got a couple little rentals in Tennessee that he owns personally, and he's depreciating them. They're doing well, they're cash flowing, but they're generating a loss on paper.
Yep.
Okay. So there's fact number one.
Yep.
Fact number two, he's got a day job 401k. And if he's got a day job and a 401k there, he's not going to be able to do anything with that. It's going to stay there. He's going to invest it the way he can't. There might be an in-service rollover if he's vested and he's made contributions. They might let him take out his contributions, but the company matching is usually always locked down.
Yep.
Then he's got a solo 401k off to the side. And he says, well, it's a solo 401k. I control it. and it's traditional money and I want to convert it to Roth, but I got to pay the tax if I convert it to Roth, which I'm willing to do because that's a good move. I never want to pay tax again. I can target it right now and rip the Band-Aid off. So Matt, these rentals over in my personal name that are generating a loss, can they offset the gain on the conversion to Roth over in my solo 401k?
It depends, Anthony. So what we want to know, the number one question is, are you a real estate professional, Anthony? Because see, when you convert to Roth, this is going to show up on your 1040 as just regular income. It's going to be taxed under your regular income tax bracket. And you get a 1099-R for it. Well, if you've got rentals with losses, those losses are usually stuck over as passive losses. You can use them to offset other rental property gains, but move it over to offset regular income or ordinary income, which is where your 1099 is going to follow on the conversion, only happens if you're a real estate professional. So if you are a real estate professional, Anthony, you're in good luck. It's going to be able to move over, and you'll be able to take that those losses to offset the conversion. Now, my guess is because you have a day job, you may not be a real estate professional. Maybe your spouse can qualify, which could help.
Now you're jumping to the good side. I'm hold on. There's two exceptions to what Matt just said. Matt, you give the first one. If
your spouse is a real estate professional, Anthony, or you want to go find one that is, then you are a real estate professional for tax purposes too, and these rental property losses can offset.
Yeah, and you've got about 6 to 7 months. Or 5 to 6 months, you could find that real estate professional by December, pull the trigger. Those losses could be really, getting married could save you a lot of money in taxes. So that's always an extra little incentive. Now, the second exception is if your income is low enough, some of those losses are going to be deductible, and the dollar amount is up to $25,000 of losses from your rentals can be deductible against your Roth conversion, but your income has got to be less than $150,000 AGI. So let's say you have a day job paying you 50 grand a year. You do a conversion for 50 grand. You've got $25,000 in losses over here. Those losses are going to wipe out that tax on the conversion. And your accountant could start doing the math to find that sweet spot, because you want to get, I don't want to convert too much. I got to figure out what my loss is, but it depends on your income. If you're making more than 100 to 150 grand a year, because there's a phase out period, then you got to go get married. So it's either or.
Yeah. Love it. All right. Bill asked a question about profit and loss allocations in self-directed IRA partnerships. It says, do profit and losses in a partnership of self-directed IRAs have to be based on percentage of contribution? For example, one party's IRA contributes 90,000, the other 10,000 for the purchase of 100,000 property. Can profits be split 50-50, or do they have to be allocated 90-10? The parties are friends and not disqualified. Okay. This is actually quite tricky question, Bill. So let me say in general, no, you cannot allocate 50-50 if you put in money 90-10. So if you're forming this at the very beginning, and let's say it's Mark's IRA puts in 10 grand and Bill, yours puts in 90 grand. As much as Mark would want, you guys can't split that profit 50-50. Mark's only going to get 10%. What did his IRA do more than your IRA? Nothing. Why would there be some weird allocation? The IRS is going to not look well at that. Now, the exception to this, and we go over this at the Self-Directed IRA Summit, by the way, strasummit.com. You can get the last recording. The next one's coming up in October 20th and 21st. 20th and 21st here in Scottsdale. Yep. And we talk about this in the supercharged section. One thing you could do, and we've had lots of successful real estate clients do this, is they will go find a property. Their IRA will own an LLC 100%. And it's going to put the money down to get the property under contract. But then they bring in a partner or partners that are going to put in more money. And this could be your exact scenario here, Bill. Your IRA puts in 10 grand and it first owns the LLC 100%. It goes and gets a property under contract. That's a great deal. And then your friend's IRA comes in and puts in the other 90K that lets you then buy this 100,000 property, and you split profits 50-50. But see, there's a difference there. Your IRA went out and found a deal. It even had it under contract. It has an asset. It doesn't own the property yet, but it's got a contract, which is an asset. Now it can bring in someone else's IRA that's non-disqualified, which is what your example is, who can pay a premium for that and more. And you can do a different allocation split of profits because you're not coming in at the same time where it's like, well, what's the difference between your dollars bill and this other guy's dollars? This person's coming in after the LLC is already formed and it already has a property or deal under contract. It already has something of value.
I love it. We're not doing well with our movie references. So I was going to throw in a little Seinfeld Kramerica. That could have been Kramer bringing in the intern,
right?
Part owner in Kramerica.
Or 10%,
Yeah.
Yeah.
It could have been a Vandelay Industry deal too. I mean,
it could have been. Yeah, it could have been Vandelay Industries. Yeah.
And it could have been a marine biologist and Vandelay. Okay. All right. Next question.
Yeah. But what does he do at Vandelay Industries? He's an importer. Is he an importer exporter? Just an importer. He's an importer exporter. All right. Okay. Sorry, guys. I got to get into the next questions. Okay. This is Rick from Nevada asks, if you already have bought precious metals to fund your 401k and are holding it in a safe deposit box, how do you get it into a depository so you'd still be compliant with a solo 401k contribution for 2020? All right, Rick. Your question assumes something you can do, which you cannot do. You cannot buy precious metals personally and then contribute them into your 401k. In fact, the only thing you can contribute to a 401k that's personal stuff is cash. It's dollars. You can't contribute crypto. You can't contribute precious metals. You can't contribute real estate. So you're, 60,000 or so contribution max between employee and employer in a 401k, for those with the solo case, that's only cash you can contribute. You cannot put in precious metals.
Matt, this brings up a question I had for you, believe it or not. But it's interesting that the opposite doesn't hold true because you can do in-kind distributions.
Yes.
But you cannot do in-kind contributions.
Correct.
So what that means, people, is if you own a rental property in your Roth IRA and you're like, well, I just want to turn it into my personal vacation home. Once you turn 59 and a half, you can just distribute it out to yourself. You don't have to sell it first and convert it into cash to distribute. So you can distribute precious metals. You can distribute crypto or real estate. You just can't contribute those things.
Yeah.
Very interesting. Okay.
Okay. All right. Final question here.
Well, this one's for me then. You've been answering all the questions, damn it.
I'm going to give it to you. I mean, I felt like I gave a sufficient pause for you to answer that one. And then I went.
Okay. All right. I want one final question just for me.
All right. This one's for you. This is a layup. This is an easy one.
Okay.
George asks, thanks so much for the knowledge drops. Can disqualify?
Well, did you just say DoorDash? Because I'm kind of hungry. Should I go to my DoorDash app? You threw me off. Okay.
Thanks so much for the knowledge drops.
Okay. All right.
Is it lunchtime? Are you hungry?
I'm hungry. Okay. All
right. George asks, can a disqualified person be the registered agent of an IRA LLC?
Oh, well, freaking A. Throw me a softball. That's not even that's a T-ball. I can go up and just that's a pinata.
Hey, that's maybe coach pitch. That's like it's not T-ball, but it's not softball.
Yeah. Now I'm making our caller feel bad that it was that easy of a question. But what's interesting here is
you want a hard one? I'll get you a hard one if you want.
No. Well, okay. I'll take a hard one. I'm feeling it.
While you're answering,
let me say this to everybody.
I'm going to find a hard one for you.
George Ash, or his question does happen quite a bit because there are custodians out there that are just butt heads. They won't let you do anything. They won't let you be the manager of your LLC. They won't let you be registered agent. But they're wrong. You can be the registered agent for your IRA LLC. You can be the manager of the IRA LLC. Now, as we talked about earlier, you can't pay yourself for that service. And because it's administrative in nature, that's why it's allowed. So don't worry about it. You're golden. You're good to go. Okay. I feel like it's Friday night and I'm playing board games and you're going to throw me a hard one. I need it. I gotta finish strong. Go to the hoop. I may fall. Right. I may not hit the alley-oop, but at least I'm going to go try.
Okay. All right.
6'9", 6'11" with the afro.
Yeah. Oh my gosh.
That's Fletch, just so you know.
Okay. Okay, let me give you this. I don't, this is average. But
Okay.
there's a lot to, I think you can make, there's some good points for this. All right.
I'm gonna have to
Question is-
clarify that reference too.
Question is, if I have two LLCs that do different kinds of businesses, is it legal to have two self-directed accounts and two self-directed 401ks?
Yeah, it is legal. You can. Remember at the very beginning, I said you can have as many IRAs and as many 401ks as you want. Not that you would administratively do that. It could be too cost prohibitive, but I think there's not a problem. And now
Okay,
I need to, yeah, I think you're fine.
My
And I need
producers
to-
have got me another question for you.
You got another one? Oh, see, I was off on my quote. It wasn't 6'9", 6'11", it was 6'5", 6'9". So Fletch playing for the LA Lakers was 6'5" with the Afro 6'9".
Oh,
And-
okay.
And he went to the hoop against Kareem Abdul-Jabbar and bit his arm on the way up. So that was an important scene in the movie Fletch. So I just wanted to make sure I don't want to, have, what did they call that website? Fact checker, whatever.
Yeah.
I didn't want to get in trouble.
Yeah, you didn't want to get like a was it Pinocchio nose? Is that what they do?
Yeah.
Two Pinocchios for that one.
Yep, for sure. Okay.
All right. Okay. This question says, I've got 155,000 in a traditional IRA.
And it
only-
starts in New York and going 60 miles an hour and gets to LA in how many hours?
I mean,
Like an LSAT question?
Yes, this is
Okay.
like that. Okay. So I got 155,000 in a traditional IRA. See, I didn't even know if that was a movie reference.
I know, I hear you.
155,000 in traditional IRA and only $95 in my Roth IRA. I was told if I convert, it's a taxable event and I'd be on the hook in a 32% tax bracket. How can I best use this mega backdoor Roth method?
Okay. So everybody out there, this is thank you, Matt, for giving me a few fast pitches here at the end of the game.
Yeah. This is just batting practice,
Yeah, batting practice. This is fun.
It's not Nolan Ryan up here.
I'm feeling it for some reason. Okay. I'm going to go to my handy dandy calendar. So I think we got a box of about 50 of these left at the office. And I'll hold it up here for you YouTubers.
Yeah.
2022 MJK monthly planner. In here, I've got multiple tables at the beginning that are very, very helpful. I've got all this data on how much you can contribute to what, but I've got these charts on the tax brackets. So this person asking this question says, I've got, let's say 150 grand, is that what it was, in traditional and 90 something in Roth. And they're saying, well, if I convert it all, I'm going to be in the highest bracket. Well, I don't know that. So what we do is we use the word chunking. So we're going to look at what bracket are you in now without any conversion whatsoever. Let's do our best to estimate. Now, as you get closer to the end of the year, this is why November and December are crazy at our office. If any of you are wanting to do year-end planning, book your appointment now. And we've got our tax attorneys are swamped. I'm swamped in November and December, because as you get closer to the end of the year, you're going to know, here's where my income is, and I might want to convert to Roth. And if you don't convert by December 31st, window's over for this year. So what we would do is find out what's your tax bracket without any conversion, and then how much can you convert before you're in the next bracket? Then how much can you convert till you're in the next bracket? Now, going from the 22 to the 24% bracket, who cares? I got a block of almost 100 grand I might convert in that range. But let's say you're on the cusp of going from the 24 to the 32% bracket. Now I got a 6% jump in tax. And I may say, well, I'm going to convert everything up to the 24% bracket. Stop. Time out. I'm out. Then wait till next year and then chunk again. And so you've just got to look at your state bracket, your federal bracket, and choose that sweet spot. Because we're not telling clients convert everything in 1 year and be in the highest bracket. That may not be your best move.
Yep. Okay. Love it. I got one last question here.
It's all yours.
You can back clean up on it if there's anything left. It says, I don't have the name of this, but this is a kind of a weird YouTube handle, but said, hold on a second. We need to clarify something. We were told by our plan administrator we were not allowed to do a backdoor Roth on any portion of a company's matching contributions. The company matching contributions are fully taxable to you, similar to traditional 401k, regardless if they are giving to you on your Roth or after-tax contributions. So basically no tax-free rollover on company matching, just the after-tax portion. Okay, that's correct. That's right. The company match that comes in are traditional dollars. They're not after-tax dollars like the employee when you put in more dollars. See, you're not taxed on the company contribution. When let's say the company matched $5,000 for you for the year, and they put in 5,000 of matching contributions. You didn't pay tax on that. It's like traditional dollars. It wasn't part of your income. It wasn't on your W-2. They just dropped $5,000 in, not taxable to you at all. When you do the after tax on doing the mega backdoor Roth, that's on your W-2. That was income to you. You paid tax on it. Hence it's called after tax. Okay. That's why you can roll it out and go directly to Roth, or, so and right into a Roth IRA. So when we're talking about the matching, whether you're doing a solo K or you got a day job 401k, that can get converted to Roth, but you will pay tax converting that to Roth because you never paid tax on it in the first place. It's traditional type dollars.
You came around to what I was going to say. And for some of you that are like, this is one of the most fascinating things that Matt and I have really figured out in the last 18 months is this mega backdoor Roth, because more and more clients have come to us and said, I want to get the maximum amount I can into a Roth, figure it out. And we're like, okay,
Figure it out.
Figure it out. So if it's a combination of your personal Roth, your contribution, maybe a company match, maybe a non-taxable contribution. There's a lot of different variables. So go to YouTube, type Kohler Mega Roth. And I've got a video there that helps explain a lot of it. It's got a lot of views. Please like it, share it. And I really try to break it down. Matt, I think, has joined me on that video. I'm not sure. Sometimes Matt's there. He's the real brains of the operation. I'm just the pretty face. It's really quite demeaning. I really felt the Me Too movement spoke to me a little bit because
you play your role.
Matt's like, Mark, you're the eye candy. Just get out there.
Someone's got to do it. Hey, whatever gets views, whatever works. That
was facetious. Yeah. People are like, I'm turning off the video.
Yeah. All right. Well, thanks everyone. Did you have anything else?
No, I'm good.
Okay. All right. Well, thanks everyone for these awesome questions. Remember, go over to directedira.com/podcast. You can ask your questions there. Also, you can vote and comment on other people's questions there if you like them or like, hey, this was helpful. Let us know that too. Then we'll definitely try to get to those questions because we cannot get to all of them. And then also, I just want to say, I don't know if you guys, we're kind of working on a new studio here in Phoenix, a little different background here. I got Hennessy and Joanna here in the studio helping me. I just wanted to kind of look like Ron Burgundy on the way out, Oh, Ron Burgundy here. I got some papers. So as we're kind of going out here, I got some,
okay.
Just want to say, as we're closing out here, stay classy, San Diego.